Hey guys, and welcome to the Roper Rundown for today. Today I'm going to be discussing the federal funds rate and how that applies to credit cards, student loans, mortgage loans, and basically the rest of the interest rate markets in the United States and the globe. So if you don't know, the Fed lowered the federal funds rate or decided that they're going to target a new federal funds rate, and they just decided this yesterday. So before, the target was between 2.5% and 2.25%. Right now the effective rate is 2.3%. Their new target is to be between 2 and 2.25%. And the federal funds rate determines a lot of other interest rates in different markets. So their decision to cut it by a quarter point, the chairman Jerome Powell has expressed concerns about a slowing economy and the ongoing trade war with China, which could raise prices on many consumer goods. Trump recently argued, however, that lowering borrowing costs would give the economy a boost and would put more money into your pocket. Just last week, the president tweeted that the central bank could cut rates to zero and even set negative interest rates, which that's a little bit speculative. For consumers, low rates do mean cheaper loans, which can impact your mortgage, home equity loans, credit cards, student loans, and car payments, as I mentioned before. On the flip side, though, you'll earn less interest on your interest-bearing savings accounts, and in some cases lose buying power over time because of that. So instead of putting your money away, it would actually be a better investment to put some of that cash into something that's appreciating faster than the interest rate market. So real estate in certain markets could appreciate at a better rate than whatever your bank is giving you for your money market or savings account. For starters, the prime rate, which is the rate that banks extend to their most credit-worthy customers, is typically about 3 percentage points higher than the federal funds rate, which that's not necessarily the case right now, especially for mortgages. So if you do the math, if the federal funds rate target is 2 to 2.5 and it's typically 3%, then you're talking about 5 to 5.25% for mortgage rates, but mortgage rates are actually sitting closer to 4% at the moment. So this not only determines your savings rate, but is also the rate used for many type of consumer loans, particularly credit cards. And credit cards have a variable rate depending on the federal funds rate and usually are astronomically high compared to mortgage rates or auto loans even. Some credit cards are up to 25% interest APR. So with the rate cut, the prime rate lowers too, and credit cards will likely follow suit. Most credit cards come with a variable rate, as I mentioned, which is a direct connection to the federal funds rate. As a result, card holders of credit cards can see a reduction in their annual percentage yield, or APR, within a billing cycle or two. So it's not exponential change, but it does have an effect. And each little basis point does make a huge difference over a long period of time, like 30 or 50 years. In terms of savings, only recently have savers started to benefit from high deposit rates. The annual percentage yields the bank pay consumers for their money after those rates hovered near rock bottom for years, right after the recession coming out of 2012. Starting in 2009, the Fed lowered the rate to stimulate the economy and kind of hedge against potential catastrophic crashes. I mean, Lehman Brothers went out of business and there was a lot of fallout. People lost their homes with foreclosures, and that's a whole nother story. But because the central bank raised the federal funds rate 9 times in 3 years, the highest yielding accounts are paying over 2.5%, up from 0.1% on average before the Fed started increasing its benchmark rate in 2015. So if you had money in the bank anytime from about 2009 to 2015, you were not getting a very good return, which is why people were buying property at discounts, because they wanted to get a better return than what the interest rate market was giving them. So online banks are able to offer higher yielding accounts because they come with fewer overhead costs, like brick and mortar locations, having to hire physical employees to operate those brick and mortar locations. There are many other factors that go to increased rates because the businesses have to cover their costs. So if you have an online business that's mostly run by technology-based services, then it's going to be a less cost especially because humans to employ people is expensive, and humans are necessary in many cases, but a lot of times with loans, not so much. If you have your money online in a savings account, the rate will probably fall, but you're still earning 20 times more than someone at a big bank than if you're investing somewhere like not Bankrate, but virtualbank.com or other online banks. There are so many. Ally is another option. There's a lot of different banks out there you can find. So alternatively, consumers can lock in an even higher rate with a 1, 3, or 5-year CD or certificate of deposit, and those are yielding 2.45 and even more, almost up to 3% return on those CDs. But there are catches. You can't take your money out without a penalty. So basically, your money's locked up for 1, 3, or 5 years, and the longer you lock up your money, the higher rate they'll give you, because the rates could change. And then if the rate's higher in the future, then you're getting less of a return than you would get if you had bought the CD at a later date. All this being said, the federal funds rate and mortgage rates are not directly linked. Like the day that the federal funds rate target changes, there may be some market change based off of lending institutions doing research on the federal funds rate and speculating on the economy and what direction rates are going. But that rate changing doesn't necessarily automatically change mortgage rates. It's up to the lender to determine what the rates are, and rates are changing constantly, daily, and it's not a monopoly. All these private lenders and institutional investors are basically competing against each other constantly for the best rate and to get as many consumers as they can. So it's very much so a competitive market. So when you're shopping around for loans, talk to several people, because you may get different rates depending on the institution. Recently, mortgage rates have edged higher on the heels of stronger than expected economic data, and that's especially the case in Austin. Property values are skyrocketing and mortgages are in high demand here. That's not to say that people are still not in competition, but in the Austin market, it's very much so still a seller's market, in my opinion. And so rates are not going to change drastically unless prices just continue to soar and people need cheaper amounts of money to be able to purchase more expensive homes. So the average 30-year fixed rate is about 4% right now, according to Bankrate.com. And that's about correct. I've worked with some clients and they've gotten pretty close to that rate if they have average credit scores and a pretty good income history through W-2 employment. Cutting your monthly mortgage by $150 a month might be the pay raise you didn't otherwise get. A few basis points on an interest rate for a loan is a huge difference, especially if you're talking about a 30-year mortgage. Paying $150 extra a month could shorten your loan term up to 10 years. You could be paying off a 30-year loan in 20 years if today you put $150 extra to your payment. And of course, if you have a 4,000 square foot house, that's not the case. This is for generally normal sized houses between the size of 1,500 and 3,000 square feet, 2 to 4 bedroom homes, that sort of thing. So the more expensive your mortgage or the more money you have outstanding in the loan balance, the more money it's going to cost you for the loan. So many homeowners with adjustable rate mortgages, which are pegged at a variety of indexes such as LIBOR or the 11th district cost of funds, may see their interest rates go down, although not immediately, as ARMs generally reset once a year. And ARM stands for adjustable rate mortgage. So an adjustable rate mortgage might be something you want to consider if you're expecting rates to go up in the future. If you're expecting rates to go down in the future, because then if you get an adjustable rate, the rate will adjust to the market at different time periods. So if you get a higher rate now and then it goes down, it would actually be better to have the rate adjusted downward. However, if rates are going up and you have an adjustable rate mortgage, then you're going to be paying more money later because the rate is going to be adjusted to what the market's going to be. So if you're worried about that, that's why people choose fixed rates, because then at least they know what their rate's going to be, and it's going to be an amortized payment that's going to be the same every month for principal and interest at least, but not taxes and insurance, because those can change based off of cost for the insurance company and what coverage you have. So just something to consider. And the Fed's consecutive rate cut will also make it slightly cheaper for consumers to borrow money from home equity lines of credit or pay back their current HELOC loans. And HELOC stands for Home Equity Line of Credit. Unlike an ARM, HELOCs could adjust within 60 days, so borrowers would benefit from smaller monthly payments within a billing cycle or two. So how does the federal funds rate affect auto loans? Good question. So auto loan rates have remained low even after years of rate hikes. Currently, the average fixed year auto loan rate is 4.62%, up from 4.34% when the Fed started boosting rates. While the average four-year used car loan rate is 5.32 because there's more risk involved in used cars transactions, up from 5.26% over the same time period, according to bankrate.com. So this rate cut also lowers financing costs for car manufacturers and dealers as well, which means car shoppers may see more favorable rates to come. So it might be a good idea to wait a couple more months before you buy a car, because the federal funds rate could actually have an effect on auto loans. Although other factors may play a role in the overall cost of a car in the months ahead, including increased tariffs on materials. So let's talk about student loans. I'm sure many of you have student loans. You pretty much have to get them these days for how expensive college is. But while most student loan borrowers rely on federal student loans, which are fixed rate, more than 1.4 million students a year use private student loans to bridge the gap of the cost of college and their financial aid and savings. So they're not even able to pay for the full amount of their college with financial aid and savings, so they're having to get privatized student loans. Privatized student loans may be fixed or have variable rates tied to LIBOR, prime rate, or T-bill rates, which I won't get into on this particular talk, which means that if the Fed cuts rates, borrowers will likely pay less in interest. Although if you will have a much less, although how much less will vary by the benchmark, what benchmark you're looking at. If you have a mix of federal and private loans, consider prioritizing paying off your private loans first, or refinance your private loans to lock in a lower fixed rate if possible. And just kind of a little fun fact to wrap up the material for this. A college education is now the second largest expense an individual is likely to incur in a lifetime, right after purchasing a home. The average graduate leaves school $30,000 in the red, up from $10,000 in the early 90s. So we've already increased now $20,000 for the average amount of money that someone is negative after they get out of college since the 90s. And I mean, with inflation, I'm not expecting that to go any lower. It's only going to get higher from here. So I mean, all of these things may sound a little complicated and scary and overwhelming, but essentially what all of this means is there's a lot of global economic uncertainty. Austin is kind of a unique market in that it hedges against economic downturns, and in many cases the best time to buy real estate is during a recession. So if we are coming into a recession, it may be a good time to buy. And if interest rates are going to continue to go down, even now would be a great time to buy, because then in a year, if rates go down, you can still refinance and get a lower rate, and then continue to refinance every year. You have to wait a year before doing any sort of mortgage activity on your house. But essentially this is an interesting time, because the Fed lowering their rate, in my opinion, essentially means that we are worried that there is going to be a recession, and we are lowering the rate to stimulate the economy so that we don't have a crash right now. So something else is going to have to give, whether it comes to student loans, whether it comes to the trade wars in China where we make some agreement, whether it comes to some kind of bubble that hasn't been identified, or perhaps the student loan bubble, which, you know, at this point there are so many student loans outstanding that I'm not really sure how people are going to pay them, and loan forgiveness is something that the government is seriously talking about. So if that does happen, that will cause a crash in the economy, that will cause a recession. Although it may benefit many people, it would not necessarily be a very good thing for our economy or the United States as a global power in the world. So basically, I follow all this stuff really carefully, and it makes a lot of sense to me. And in terms of Austin real estate, I am extremely bullish on the market. I have several investment properties that I've purchased in the last several years, and I'm going to continue to do so over the coming years. And I would recommend anybody thinking about doing so to reach out to me via email, phone. We can meet up for a coffee and just chat. There is no pressure involved. I'm looking to help my clients achieve their goals, not push properties on people or make something work that doesn't work for my client. I want to make sure that you understand the process and that you are comfortable with all the steps involved and are excited to move forward with purchasing a home for either yourself or as an investment. And I think either would be a greater play than the stock market, or a greater play than even putting your money into a savings account. If you're looking for a riskier investment, because there's risk involved in all investments. If you put your money into an FDIC insured savings account, you have almost no risk if you don't have over the limit of what they require, but you're not going to be making more than what the market is. And if you're not at least making inflation, a return on your money that you have, then you are losing compared to the rest of the investing world. So if you guys would like to have a chat with me, just a candid conversation about investing or real estate, I have a background from Goldman Sachs, grew up in Austin my whole life, I know all the neighborhoods, and I have great resources at Compass, and I'm excited to have the most successful year of my career so far. Thank you guys so much for watching, and tune in next time for another informative talk about the economy and the Austin real estate market. Talk to you soon, guys.